For decades, millions of people have been shut out of the American dream, held back by an invisible system designed to keep them from building wealth and accessing credit. The scars of redlining and segregation still run deep in our neighborhoods, and credit reports and the scoring models we rely on today carry the weight of this history with them. But now something is finally shifting. The monopoly of credit scoring is cracking wide open, introducing new players with new data and new hope. But the fight is far from over because beneath the surface, the system still holds bias and barriers that keep too many people stuck, especially African Americans who have been systematically denied opportunities they deserve. This is the story of credit scoring, the hidden forces shaping your financial life, and the battle to make it fair for everyone. What's up, guys? This is The Network back with another video, and today we are talking about something huge that's shaking up the credit scoring world, and it's going to impact how millions of people get access to credit and mortgages moving forward. We are talking about the changes happening with the FICO score and the VantageScore and how this competition is finally starting to heat up. So listen close, because this is a major shift in the game that could open doors for a lot of people who were previously overlooked by the traditional credit system. For years, FICO has basically had a monopoly when it comes to mortgage credit scores. If you wanted to get a loan backed by Fannie Mae or Freddie Mac, the only option lenders had was to use the classic FICO score that gave FICO almost total control over the scoring model market. That meant the models stayed pretty much the same with little competition and fewer innovations. And that created challenges for a lot of consumers, especially those with thin credit files or limited traditional credit data, because the classic FICO model doesn't really consider alternative data like rent or utilities payments. But that's starting to change thanks to a policy shift led by the Federal Housing Finance Agency, the FHFA, who oversees Fannie Mae and Freddie Mac, and it's based on legislation passed in 2018 that was designed to bring more competition to credit scoring. This law was called the Credit Score Competition Act, and it basically required FHFA to allow lenders to choose between using FICO or VantageScore 4.0 for mortgage underwriting without forcing them to use both. Now, what makes VantageScore 4.0 interesting is that it includes data sources that FICO traditionally left out, things like rent payments, utility bills, and even telecom payments, and that means it can score people with less traditional credit history, giving a chance to millions more people to get credit approvals, including mortgages that they would have been denied before. According to VantageScore's own data, their 4.0 model predicts mortgage defaults better than the classic FICO model, and it includes around 11% more people who were excluded previously because of sparse credit data. That's a big deal for people with thin files or those trying to build credit from scratch, but FICO isn't backing down, and they have launched their own newer model called FICO 10T that claims even better predictive power, especially in spotting default risk. So right now, there is a battle between these two scoring models, with each claiming to be better at predicting risk and serving consumers better. And this new lender choice policy opens the door to competition that we haven't seen before, since it's breaking FICO's monopoly. This could also mean lower licensing fees for lenders, which might translate into more affordable credit products down the line. But it's not a one-size-fits-all solution. The truth is, both scoring models have their strengths and weaknesses, and the industry is still watching carefully to see how these changes will really affect access to credit and affordability, especially for underserved communities that have historically been excluded or marginalized by traditional credit systems. In this video, we will dive deep into what these changes mean, how the scoring models work, what data they use, why this matters to you, and how it might affect your credit access and loan approvals. So stick around and we'll break it all down step by step. Also, if you want to get help or have questions, you can always reach out to the network on Discord. Telegram is no longer reliable, but you can follow us on Instagram for daily updates at the network link. And remember, every video on this channel has a full method included inside our Patreon, which is only $50 a month right now. And anyone who locks in at this price gets grandfathered in for life, so don't sleep on that. Let's get into it. All right, guys, now let's get into how these two scoring models differ technically and what that means for you on a practical level. So first off, FICO 10T takes credit scoring to the next level by using something called trended data. What that means is, instead of looking at your credit behavior just at one point in time, it tracks how your balances and utilization change month over a longer period. It rewards you if you're steadily paying down your debts and using less credit, and it penalizes you if you're letting your balances creep up. So it really pays attention to the trends in your credit habits. VantageScore 4.0 also uses trended data, so it's not behind on that, but where VantageScore goes further is by including alternative data sources like rent payments, utility bills, and even telecom payments. So if you're someone with little or no traditional credit history, but you always pay your rent and utilities on time, VantageScore can actually factor that in and give you a better score, which is huge for thin file borrowers or people who have been invisible to traditional credit models. Now, FICO 10T doesn't fully include mortgage payment history in their scoring, because they want to avoid penalizing people who don't own a home, but when available, it may include rental data, which is a nice middle ground, so they are careful about how they weigh this alternative data to avoid unfair bias. Another important difference is how these models treat collections and medical debt. VantageScore 4.0 downgrades the impact of medical collections more than previous versions, meaning if you have healthcare-related debts, that shouldn't hit your score as hard, which is good news given how medical debt affects so many people. When it comes to predictive power, FICO claims that 10T significantly outperforms the classic FICO, and even VantageScore 4.0 with data showing it can detect 18% more default risk and a 5 times improvement over older models, but independent sources say VantageScore 4.0 can be up to 15% more predictive during tough economic conditions like the COVID-19 pandemic, so the jury is still out and both have solid claims. FICO has also raised concerns about VantageScore's use of mortgage-specific indicators, saying it disadvantages renters, younger buyers, veterans, and underserved groups, while FICO 10T avoids mortgage history entirely to sidestep that bias. But at the same time, VantageScore's inclusion of alternative data can be a game changer for inclusion overall. Now, what about the long-term impact on borrowing costs and equity in lending? Well, this new competition between FICO and VantageScore could actually drive down the licensing fees lenders pay to use these scoring models fees that have risen from about 60 cents to almost $5 per score, which can make a big difference in mortgage costs if lenders pass on savings to consumers. VantageScore 4.0 has the ability to score around 33 million more consumers than FICO, including roughly 13 million who have scores over 620, meaning potentially 5 million more people can qualify for home loans, which is massive for expanding home ownership access. And it's even estimated that this change could unlock $1 trillion in additional mortgage lending opportunities. But despite these gains, there are still deeper systemic problems like racial bias in scoring algorithms, lack of transparency, and unequal data reporting, which means the playing field isn't perfectly level yet. Another limitation is that benefits from alternative data like rent payments depend on whether landlords and utility companies actually report that information consistently. Only a small fraction of people are currently helped by programs like Experian Boost, so this is a work in progress. So what does this mean for you and your credit access if you have a thin credit file or use non-traditional credit sources, paying rent, utilities, or phone bills on time? VantageScore 4.0 can give you a big boost in qualifying for loans, especially mortgages. If you have a growing credit profile and consistently pay down balances, FICO 10T rewards that behavior more strongly. So you may see your score improve faster as you reduce debt over time. With lenders now able to choose which scoring model to use, your borrowing costs could vary depending on which score favors you more. So it's smart to keep an eye on both scores if possible and know which model lenders prefer for different types of loans. This could influence your approval odds and interest rates. Score models are also evolving. For example, FICO 10T will soon include buy now, pay later data, which could positively or negatively affect your score depending on how you use those services. So staying informed and disciplined is key. To sum it up, FICO 10T leans on nuanced debt behavior and strong default prediction, backed by proprietary data, while VantageScore 4.0 focuses on inclusivity and scoring. People traditional credit ignores. Both have their place, and the competition between them means more options and potentially better access to credit for many consumers. Now let's talk about something that's super important and often overlooked when we discuss credit scores and lending, and that's racial disparities and bias in the credit system. Understanding this is key because these scoring models don't exist in a vacuum. They are built on historical and systemic data that has real consequences for millions of people. The roots of these disparities go back decades, starting with practices like redlining, which began in the 1930s when the Federal Housing Administration and private lenders refused to offer loans to people living in predominantly black neighborhoods simply because of their race and where they lived. This cut off whole communities from home ownership, wealth building, and financial security, and those effects have rippled through generations, making it harder for many minorities to build credit and accumulate assets. Today, minority consumers, especially Black and Latino individuals, tend to have lower median credit scores and are overrepresented among those with no credit score or files that are unscorable. This is partly because the data collected on them is noisy, incomplete, or thin, making their scores less accurate predictors of their true credit risk. And this creates challenges when lenders rely on these scores to make decisions. Studies show that even when automated underwriting systems are race-blind, minorities are less likely to get approved for loans and often need higher credit scores compared to white applicants. This isn't just about the numbers, though. Black and Hispanic borrowers face debt collection judgments far more often than white borrowers, even with similar credit profiles. And AI systems that many lenders use can still have biases embedded in how they process applications, leading to higher denial rates or worse terms for minorities. There's concrete documented proof of this from a wide range of sources, showing that African Americans are 3 times more likely than whites to have low FICO scores, and Hispanics are twice as likely. And neighborhoods with majority minority populations consistently have much lower average scores. This has real impacts on lending. because research shows being African American can be like having a credit score 71 points lower when loan officers evaluate applications. The Justice Department and housing agencies have taken legal action against banks for redlining and steering loans away from minorities, with multi-million-dollar settlements against major banks like Wells Fargo and Bank of America. These actions confirm that systemic bias isn't just theoretical, it's documented and ongoing. So how is this being addressed? Well, there are a few key reforms and innovations aiming to fix these problems. One is the Community Reinvestment Act, which since 1977 has required banks to serve all communities, including low-income and minority areas. Recently, regulators updated the act to cover online and mobile lending and beef up support for underserved groups starting in 2026. There are also proposals to create a public credit registry managed by the Consumer Financial Protection Bureau to replace private credit reporting agencies. This would include transparent scoring algorithms designed to reduce racial disparities, automatic dispute resolution, and faster removal of harmful data like medical debt. On the innovation side, companies have launched alternative data products like Experian Boost, Fico XD, and Credit Vision Link that bring in rent utilities and transactional data, helping thin file and minority consumers get scored more fairly, but watchdogs warn these tools must be carefully validated to avoid replicating discrimination. Technical solutions using machine learning are being developed to remove bias from these scoring models using causal inference and other techniques to improve accuracy and fairness across racial groups. Finally, there is a push for scoring models to become more transparent and consumer-friendly, allowing people to understand how scores are calculated, dispute errors more easily, and engage with the system instead of it being a black box. The bottom line is, while progress is happening, this is a complex systemic issue with a long history, and the credit scoring industry still has a lot of work to do before everyone gets a truly fair shot. This is why the network exists. Most of us found our way into this credit and business niche because we faced the hardest challenges getting approvals, especially early on, and came from families and communities with little to no access to this kind of financial knowledge. That struggle put us in a position to create new ways to navigate the system. If you look around, you'll see it's mostly people like us in these credit spaces, CPNs, business credit, and beyond, because we're the ones who've been blocked the most. So we built our own communities and our own playbooks to share real knowledge and find paths out of this financial matrix. It's not just about credit, it's about reclaiming control and building freedom on our own terms. And this is the network. Thanks for watching. We'll see you on the next one.